Joining us right now with her take on the markets on this last trading day of September and of the third quarter is Elyse Ausenbaugh. She is the head of investment strategy at JPMorgan Wealth Management. And Elyse, let's talk this through. We're looking at a really strong quarter. I think the S&P was up by better than 7% so far for the quarter. The NASDAQ up by better than 11%. Do you think that momentum continues?
We do think the momentum is going to continue. I mean, when you think about the macro backdrop, obviously it's been a challenging 2025, but as we look ahead to 2026, there are reasons to expect improvement on that front. And with these powerful tailwinds related to things like AI investment, we are believers that the rally has more upside ahead.
What is driving things right now, especially when you look at the weaker market? Is this a Fed-induced rally, or do you think that the numbers that corporations are putting up is the real reason for this?
I think it's a mix of both, right? We can't discount the value of the Fed rate cutting cycle. We've been implementing our so-called Fed rate cutting playbook, and we expect that to play out absent a recession going forward. When you look at things like corporate profit margins, still around the highest levels that they've been throughout this cycle. When you think about all of the investment that's being funneled into infrastructure supporting artificial intelligence and the way that that's filtering through sectors. And when you look through and kind of think about all of the uncertainty that's finally starting to dissipate as it relates to things like tariff policy, we think that there is a path ahead to kind of keep valuations supported, but also continue to fuel earnings growth.
The jobs market been disappointing. Is it something that worries you that could expand from here?
So it's something we're watching really closely, but we would characterize the labor market as bending but not breaking. You've obviously seen this substantial slowdown in hiring. It's about the slowest pace that we've actually seen absent the pandemic era since the global financial crisis. But what we're not expecting is a meaningful rise in layoffs, because to see that, usually throughout history, it would require a meaningful deterioration of corporate profit margins. And with this momentum that we have going, we think that they can stay fairly well supported.
What do you think in terms of this government shutdown? You haven't mentioned it once. We keep talking about it. You think this is a blip? You think it either gets taken care of or it doesn't last for very long and is not going to be impactful?
Look, your guess is as good as mine. We've seen multiple government shutdowns since the early 80s. And what we found is that, one, they vary in length, but the length itself doesn't have all that much weight in terms of how markets perform. On average, stocks actually tend to rise. You actually see a modest decline in treasury yields. I think this time around, what we have to be mindful of is kind of the absence of some of that economic data should we get the shutdown and not receive things like the payrolls report this Friday, because it could just add further confusion and a lack of clarity to an already muddled macro picture.
What are you expecting on Friday if we do get that jobs number?
So I think it would be nice to see a modest pickup in the pace of hiring, but we're not yet calling for a big, meaningful reacceleration. It's possible that you still see some of the lingering effects of the federal government layoffs from earlier this year start to show up in some of that unemployment data. We wouldn't be surprised to see the unemployment rate tick a little bit higher through year end, but still not calling for the labor market to totally collapse and deteriorate. And we think all of those ingredients keep the Fed on track for this kind of modest, gradual rate cutting cycle into 2026.
There's been so much spending in technology and CapEx spending for AI. That has been a huge strength of the market. Where do you think the consumer stands at this point?
So I think the consumer is faring okay. You have had wage growth start to slow, but you're still getting that positive real wage growth that should continue to support consumer spending, obviously so long as consumers remain employed, right? You also have these wealth effects from the stock market rally that we've seen so far year to date. So despite all of kind of the agita and maybe the downtrodden sentiment, the consumer's hanging on. But when we think about aggregate GDP growth, as we learned in the first half of this year, it's not the only thing driving the expansion of the economy, because that AI investment has been playing a massive role as well.
If we don't get government numbers, if there's a shutdown and there's an extended shutdown and we don't get government numbers for a while, where would you be looking?
Look, I think you can, look at things like JOLTS data, ADP. We have lots of models to kind of get a sense of how those things are trending, and also other private sources of that kind of data. And then, of course, with the upcoming earnings season, we'll be listening very closely to corporate commentary and kind of taking cues from that.